There is a massive debate on the internet as to whether technical analysis actually works. Some people say it is astrology for investors. Other people say that they reliably make money by using it. But I don't care what randos on the internet think. I want to know what the greatest investors of all time say about technical analysis. So I spent the last 3 weeks scraping the internet for all of the interviews and the quotes that I could find. And it turns out this is not a new debate. It's been going on for over 40 years. One of the first and most interesting interviews I found was actually a head-to-head debate between two prominent investors at the time. One represents fundamentals, the other represents technical analysis.
Let's talk with two successful professionals whose methods could hardly be less similar. Peter Lynch is a fundamentalist. That is, he researches the very basics of a company, such as its earnings prospects and who its managers are, before deciding which stocks to buy. He does this with outstanding success. In a recent survey, the mutual fund he manages, Fidelity Magellan, rated as the best performing mutual fund of all over the last 10 years. Stan Weinstein, on the other hand, doesn't care if a company makes beans or bullets. He's a technician, what I call an elf, and he uses charts and graphs and other arcane indicators as his selection technique.
Not sure how Stan felt about being called an elf, and it's clear that the interviewer is already leaning towards fundamental analysis back in the 80s, as he's referencing technical analysis as being arcane. And I gotta admit, I had my own bias going into this research because I prefer to use fundamental analysis, and I'm aware of tons of quotes out there from the famous investors of all time that are disparaging technical analysis. Warren Buffett is quoted as saying, "I realized that technical analysis didn't work when I turned the chart upside down and I didn't get a different answer." Charlie Munger said that "I have the faintest idea what technical analysis is. I regard it as astrology." Peter Lynch said charts are great for predicting the past. So there's lots of quotes out there that are against technical analysis, but I knew that there's got to be some of the greatest investors of all time that actually use it because it is so prevalent today. The debate is so strong online, they've got to be out there. And the first guy I found uses the best from both worlds.
So no, I don't necessarily sell early. I'm a technician, so I usually wait for tops. NVIDIA had no top. One of the reasons charts work, the reason there's support and there's resistance is the resistance is a bunch of people that bought it at 60 and it went down and they've been waiting for 3 or 4 years for it to get back to 60 while they could have been in something else that was going up the whole time.
That was Stanley Druckenmiller, one of the greatest investors of all time. This guy managed money for George Soros. He was his lead portfolio manager for the Quantum Fund. Stanley even started his own hedge fund and built it up to over $12 billion in assets. In that clip, he's clearly a self-proclaimed technician, talks about some of the underlying fundamentals for why technical analysis works. But Stanley isn't purely a technician either. Here is an interview transcript of him talking a little bit more about his approach. "I like a multidisciplinary approach," he says. "My first boss taught me technical analysis, so I use fundamental analysis and technical analysis. If there are thousands of securities out there and my portfolio is only going to have 15 to 20, I'm never going to buy something that doesn't have a great chart and great fundamentals." So clearly, one of the greatest investors of all time is successfully using both of these techniques simultaneously, and he's not the only one to do this.
Now what I did was I went from being a fundamental analyst to being a technical analyst because I felt more comfortable with math. And what I did was I started buying chart books and taking a ruler and just drawing lines. It was pretty simple. If the line was pointing down, I wasn't interested in it. If the line was pointing up, I was going to try to ride the trend as a momentum trader.
That was Martin Schwartz, a successful Wall Street trader who made his fortune trading stocks, options, and futures. He became famous when he won the U.S. National Investing Championship in 1984. And this is a guy who started out as a fundamental analyst and then switched completely over to a technical analyst. And that is where he made his fortune. He actually had more success moving away from fundamentals. So we have opinions all over the place. Technical analysis is useful. Technical analysis is not useful. We even have people saying that technical analysis needs to be used in conjunction with fundamental analysis. Stanley Druckenmiller says he would never buy a stock that doesn't have great fundamentals and a great chart. So at least at this point, there isn't anybody that says fundamentals aren't useful, right? Oh wait, there are some. Ed Seykota is a world-famous trader who pioneered trend trading and has amassed billions of dollars. He's famous for taking one of his clients' accounts from $5,000 up to $15 million, and that is with his client withdrawing money along the way. So he could have got that account even higher. In the book Market Wizards, Ed has an interview where he gets pushed on his thoughts. The interviewer asks him, what are your thoughts about using fundamental analysis as an input in trading? Ed says fundamentals that you read about are typically useless as the market has already discounted the price. I call them fundamentals. Basically, disregarding fundamentals completely. He says, I am primarily a trend trader with touches of hunches. In order of importance to me are 1, the long-term trend, 2, the current chart pattern, and 3, picking a good spot to buy or sell. He said, in distant fourth place are my fundamental ideas, and quite likely on balance, they have cost me money. So here we have one of the most well-respected traders of all time, basically saying that fundamental analysis has actually cost him more money than it has made him. And his ideas, even though this book came out in 1989, his ideas that fundamental analysis is too competitive is supported today. The current most successful hedge fund of all time does not use fundamental analysis at all. Jim Simmons founded Renaissance Technologies, which is today regarded to be the most successful hedge fund in the world. In the history of the world, their medallion fund averaged 66% returns over a 30-year period, which is absolutely unheard of. The average stock market returns in a year is about 10%. And this fund does not use fundamental analysis at all. Now, they technically, I would call them a quantitative firm because they're pulling in big data. They're not using technical analysis in the colloquial sense. They're not using what you might think of when you hear technical analysis. They're not looking at charts and plotting out lines of supply and resistance. They are putting in terabytes and terabytes and terabytes of data into their computing models, and they are finding trends in that way. Everything from weather to commodity prices, it doesn't matter. They're putting it in their computer. But coming from the most successful investor in the history of investing, Jim Simmons has some pretty startling quotes. He says, we never hired anyone from the financial world at Renaissance. We never did because they didn't have anything to add, I don't think. There were people who wrote papers or departments of finance or something at business schools. And some of these people written papers about predicting the stock market or stuff like that. We looked at a bunch of these papers. They were all wrong. Every paper was wrong. So we stopped bothering looking at these papers because they were all wrong. I have one guy who has a PhD in finance. We don't hire people from business schools. We don't hire people from Wall Street. We hire people who have done good science. So they are purely focused on the numbers, the statistics, and the technicals. But something isn't sitting quite right with me. Isn't it strange that fundamental analysis supposedly doesn't work because the market is already implementing fundamental analysis so quickly? I mean, Ed Seykota called them fundamentals. You can't rely on fundamental analysis because the market has already priced it in. So how is the market doing all of this fundamental analysis? And I'm supposed to say that fundamental analysis isn't good. It's kind of like a chicken or the egg question. Technical analysis only works. In fact, it seems like it requires a vast market of people doing fundamental analysis so quickly and so competitively. Technical analysis requires tons and tons of buy-sell data points, and you wouldn't have those buy-sell data points in the first place unless somebody had an idea of what to buy or what to sell using fundamental analysis. As I'm going back through the interviews looking for answers, I start to pick up on a common distinction that gets made again and again. Trader versus investor. Ed Schwartz, who actually went through both phases, fundamental and technical, said it explicitly.
Trading is a very short time horizon. And the reason why I became a trader was, as I told you, I'm an inveterate gambler, but I also needed leverage. And that was the way I could make a lot of money or blow myself up as far as my capital position.
Stan Weinstein makes the same distinction in his debate with Peter Lynch.
When it comes to trading, I strictly would be a technician, but from a very long-term investor, I know people who have successfully synthesized the two, but I've got to tell you, with my prejudice, I'll always lean towards technical. I'll never buy a bad chart pattern no matter how good the story is.
Even Jim Simmons of the Medallion Fund references the shorter timetables. He says, we stayed ahead of the pack by finding other approaches, shorter term approaches to some extent. The real thing was to gather a tremendous amount of data. But I think Bill Ackman says it best when he talks about the lessons that he gained from his inspiration, Ben Graham, one of the most iconic investors of all time.
He talked about the difference between, the stock market in the short term is a voting machine. It represents speculative interests, supply and demand of people in the short term. But in the long term, the stock market's a weighing machine, much more accurate. It's going to tell you what something's worth. And so if you can divine what something's worth, then you can really take advantage of the market because it's really here to help you. And that's kind of the message of the book.
The key phrase there is, if you can divine what a company is worth. And that really is the key to fundamental analysis. You have to be able to come up with an approximation for the intrinsic value of a company. I'm a long-term investor. I prefer fundamental analysis, and the way I calculate a company's estimated intrinsic value is using their discounted free cash flows. Check out my automated spreadsheet right here. And Lily?